The stochastic oscillator is a popular momentum indicator developed by Dr. George Lane in the late 1950s. It looks at where today's close lies compared to a recent trading range. It's based on the idea that prices tend to close near the day's high in an uptrend and tend to close near the day's low in a downtrend. Typically, a 14-day period is standard with the stochastic oscillator, although it can be modified by the user. The stochastic oscillator is range-bound between 0 and 100. A reading above 80 suggests that the instrument is overbought, whilst a reading below 20 points to it being oversold. However, 20 and 80 can be changed to, say, 30 and 70 or 25 and 75, depending on the volatility of the instrument that you're looking at. There are two elements to this oscillator. There's the faster percentage K line and the slower percentage D line, which is a 3-period moving average of the percentage K line. A signal is generated by the stochastic oscillator when the faster percentage K line crosses the slower percentage D line, whilst the indicator is either in overbought territory or in oversold territory. The signal can be an early warning sign of a trend change, particularly if there's divergence taking place between the oscillator and the price as well. This is an indicator that tends to work best when the instrument is range trading rather than trending higher or lower. The stochastic oscillator is popular because it's simple to spot when an instrument is overbought or oversold, while those crossovers provide an additional dimension. The main drawback, though, is it can sometimes generate false signals or whipsaws. Let's take a look at a real-world example now. This is the chart of dollar-yen. Now, if you drag your mouse over to the top here, you can see that you can click on indicators. When you scroll down, you'll see that you can tick or untick the stochastic oscillator. So I've annotated this chart with the stochastic oscillator. We can see that the 80 line and the 20 line are drawn on there for us already. If this indicator is above 80, that means that the instrument is looking overbought. If the indicator is below 20, that suggests that the instrument is looking oversold. Now, the key signals come from the crossovers of these two lines when we're either in overbought or oversold territory. And here is an example of one. The black line is the faster percentage K line. The dotted red line is the slower percentage D line. We had the percentage K cross below the percentage D line whilst we were above 80, and that would be an indication of a potential trend change to come. And on top of it, we also had divergence because we can see that the indicator is posting a lower high, but prices are posting higher highs. And so with all of that combined, that is an early warning sign of a trend change. And we can see shortly after that prices began to fall.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.